morning.
Hey, Geraldine, you've got a question?
Sorry, Mr. Take that down.
Yeah, well, I think we can begin. I'm sure there'll be some participants dialing in late, but I think it's best to start. Okay, thanks all, and good morning to everyone, and welcome to the first session of day one of the Growthpoint Investor Showcase for 2021. The virtual event will be hosted over 2 days, and each session will follow a similar format with a presentation up front for 20 to 30 minutes, followed by Q&A. We will begin the day with a business update from Growthpoint Australia by Timothy Collier, the CEO. Just some housekeeping issues before we begin, but nothing new. Can you please remain on mute and ensure your video is off? The Q&A will be at the end, and you're welcome to post your questions in the chat box function, raise your hand function to ask your question directly, or email me and I'll run through those during the Q&A session. So thank you very much for joining, and over to you, Tim.
Good morning, everyone, and thank you, Nazim, and the broader Investec team for hosting this event. I'm pleased to have the opportunity to present to you this morning. I know that Norbert regularly provides updates on GOZ with GRT's financial results and elsewhere, so I don't want to rehash these in too much detail today. Rather, I thought I'd provide firstly an update on GOZ's strategy, an overview of our performance during the COVID-19 pandemic, some key trends we are seeing in our property sectors, metropolitan offices and industrial, and the outlook for Australia, which is quite strong and we're quite bullish about. I'll then be happy to take your questions. So firstly, on the slide on the screen, provides an overview of our 4 strategic pillars. The first 3 have been key priorities for the group for a number of years. We invest in high quality, modern assets with good green credentials that are well located. We maximise the value of our existing assets through leasing, refurbishment, expansion, development or divestment. We are focused on maintaining high occupancy and income, with the occupancy historically being between 97% and 100%. This strategy has enabled us to deliver a consistently strong performance since GOZ's inception. The 4th pillar, entering funds management, is relatively new. We believe that by entering funds management, we can generate higher return on capital employed for our security holders, particularly in a lower growth environment. Our target is to generate between 10% and 20% of earnings from funds management over the medium term, with the remaining amount to come from assets we hold on our balance sheet. To this point, we've been focused on acquiring an existing fund manager to achieve scale. If we're unable to find the right opportunity for our business, we could purchase and warehouse assets on our balance sheet prior to launching a fund, and or use existing balance sheet assets to form a fund. Moving to the next slide. Reflecting the strength of our strategy, our business has proven resilient over the past 18 months, despite COVID-19 causing significant disruption in our operating environment. Pleasingly, we have seen no direct material impact on our financial results from the pandemic to date. For financial year 21, funds from operation, which is our primary earnings measure, was 25.7 cents per security, which was at the upper end of our upgraded guidance and 0.4% above the previous year. We were pleased that we were able to deliver growth as we started the year with a $10.4 million headwind to our earnings as a major tenant had vacated a large industrial asset in financial year 20. Our occupancy significantly increased over the year to 97%. Securing Bunnings, the largest hardware retailer in Australia and one of the best companies in Australia, as a key tenant for our recently completed development in Melbourne, Botanica 3, was a really great result. We also signed a new 10.5-year lease with Australia Post in a large industrial property at Adelaide Airport. We were also pleased to see strong tenant retention through the portfolio, with key tenants, the South Australian Government, Monash University and Laminex, amongst others, all renewing their leases. For lease renewals, we were pleased that there was no significant change to tenants' space requirements, and our tenants continued to seek long leases, with the average lease term of all leases negotiated being 8.2 years. As a result of this leasing success throughout the year and cap rate compression in our market, the value of the group's portfolio increased by 10.2%, $416.8 million over the year on a like-for-like basis. And this was the largest 12-month increase in property values in the group's history. Our balance sheet remains robust, with gearing around 30.2%, well below the group's target range of 35 to 45%. This puts us in a good position to pursue growth opportunities, and the team are actively looking to acquire new properties, or as I said before, an existing funds management platform. Moving to the next slide on the office market. One of the reasons our business has continued to perform strongly is because GOZ's exposure is limited to two subsectors of the property market: metro offices and industrial logistics, which have both performed very well during the pandemic. In Australia, there continues to be ongoing speculation about whether a permanent shift to more flexible working arrangements will lead to a sustained decline in office demand. Whilst it remains too early to call long-term trends, we are seeing encouraging signs that while a degree of flexibility is expected to remain, it is unlikely to drive a long-term reduction in office space requirements. Before the latest COVID-19 lockdowns, analysis undertaken by the Property Council of Australia had shown that increasingly workers were returning to the office, and in some capital cities, physical occupancy was just below pre-pandemic levels. Whilst the same analysis does not exist for metro offices, across our portfolio, we're generally seeing higher physical occupancy than recorded by the PCA for central business districts. This may be driven by some of the attractive features of metropolitan offices in a post-pandemic world, such as metro offices generally having less levels, meaning shorter lift wait times and larger floor plates, which support physical distancing. Metro offices are often located close to where people live, reducing time spent on public transport, One of the largest concerns cited by employees when returning to work, and many surveys have brought that fact up. Metro offices generally have a higher ratio of car parks than CBD offices, so people can drive to work. And of course, there is a significant cost saving to leasing office space in the metropolitan market versus the CBD market. Across Australia, we have seen a decline in net effective rents, primarily driven by higher leasing incentives, which we believe have bottomed. Rents in most metro areas are holding up better than their CBD counterparts.
2.5 million shares.
Historically, some commentators have speculated that when CBD rents decline, tenants based in metro locations will choose to locate to the CBD, and it has become relatively more affordable. To date, we haven't seen that trend. In Sydney and Melbourne, we've seen a number of high-quality tenants commit to metro offices, as we've highlighted on this slide. Moving to the next slide, the industrial market. The industrial market continues to go from strength to strength. As a result of the rise in e-commerce in Australia, alongside other trends, occupier demand for industrial space reached a record high of 2.9 million square metres in 2020. In the first half of 2021, gross take-up had already exceeded the average annual take-up over the last decade. So very strong demand from occupiers. JLL also estimates there is currently $45 billion of capital earmarked for investment in Australian industrial assets. This is more than 3 times the value of total industrial transactions in financial year 21. So low supply of industrial property for sale and very high demand. As a result of this strong investor appetite, yields have tightened significantly over financial year 21 and over the last few months, with prime yields in the low 4 range and with super prime yields for modern assets with long lease expiries of around 3.5%. Since our last round of valuations, we've probably seen, as I said before, further cap rate compression of at least another 25 basis points. Finally, before I open up to questions on the next slide, I thought I'd make some comments on the current economic environment in Australia. As you may be aware, from a health perspective, Australia has fared relatively well throughout COVID-19, particularly in the first 12 months of the pandemic. When I spoke to you at this time last year, around 27,000 people had COVID and 900 people had died across Australia. Nationally, there are only 250 active cases. It appears that due to the small number of cases, there was a sense of complacency regarding the vaccine rollout, and it was much slower here than in other developed countries. As a result, when the Delta variant arrived in Australia, large parts of the nation were plunged back into lockdown, and that included Sydney and further lockdowns, number 6 in Melbourne. However, over the past couple of months, there's been a huge push to get everyone vaccinated, and now over 80% of people over the age of 16 are fully vaccinated, and that continues to. So thankfully, we are now opening back up and life is returning to normal. So looking forward, we have a greater optimism, and that should lead to greater business confidence. The Reserve Bank of Australia is forecasting GDP growth of 3% in 2021 and 5.5% in 2022. They also expect the unemployment rate to decrease to 4% by the end of next year. So the underlying economy is strong, due largely to massive and unprecedented government fiscal stimulus throughout the pandemic, as well as highly accommodative monetary policy. So in concluding, we are confident about the future with high occupancy, a long weighted average lease expiry and a very strong tenant base. We have been protected from the short-term economic challenges presented by the pandemic, and we are well positioned to benefit as conditions improve. We have provided guidance for financial year 22 of funds from operation of at least 26.3 cents per security, which represents growth of 2.3%, and distribution guidance of 20.6 cents per security, up 3% on financial year 21. Thank you for listening. That wraps up my prepared comments. I'll be happy to take any questions you may have.
Brilliant. Thank you so much, Tim. Just a reminder to the participants, if you'd like to ask a question, please use the chat function, raise your hand function, or you can pop me a mail. We've got a question from Ridwan to kick us off. Good morning. Please, can you discuss what has been the major driver of valuation increases in Australia, given the pressure seen on rent, as your slide shows? If it is cap rate compression, then is this a disconnect and unsustainable?
Probably in difference. I think 3 points. Probably overall investors, global investors, underweighting in property, and they see Australia as a modern, transparent economy with good growth coming. So they're attracted to our market, and we've seen really the yields in Australia converge with global yields in Europe and the US. So there's convergence of global yields, and Australia's benefiting from that. Secondly, I think in the office sector, office valuations are holding up and sales are occurring above previous book values. A lot of investors, domestic and international, are seeing through the short-term ructions in the office market and looking longer term, and the fundamentals for the economy, business growth, business profits remain very good. So they're looking through that. And then I think within the industrial sector, where the greatest yield compression has occurred, that is the most favoured asset category globally, and the demand for industrial space has been spurred on by e-retailing, and it's effectively the growth in e-retail has been brought forward several years, maybe up to 5 years, from the pandemic and the lockdowns and people ordering goods online. It's brought that forward, and the demand for space from retailers is significant. So the investors have seen, and we're seeing it now, real rental growth in the industrial market, and particularly offshore investors and US investors have seen what has happened in the US and parts of Europe, and they're prepared to pay lower yields on the basis of higher rent growth. So for example, maybe 6-9 months ago, investors may have been forecasting 3% compound growth in rents in the industrial market over 10 years in their discounted cash flows. It's now approaching 4%. So that's a rental growth story. So I think 3 points, I think our yields are converging to global yields. It's an attractive investment destination. I think office investors are looking through the cycle, and then for industrial, it's more of a rental growth story.
And just talking to industrial, I think you had a number of 45 billion with regards to capital, looking at the sector as well as the take-up of space. Would you've done developments before? Are you looking at development activity in this space to maybe attract better yields, or would you still prefer income-generating assets as opportunities?
Generally speaking, income. The margins within developments are not significant. for the relative risk, and it's extremely competitive at this point in time. So we may buy assets off developers, but we're not at this point in time going out and buying land banks. Land values themselves are obviously at historic highs as well. So not at this point in time.
And then just moving on from, the interim results, you put out a quarterly update as well. Maybe just, a quick update on the transactions since financial year 21, taking the LTV to 30.2. Maybe can you provide some, detail on that?
Yeah, certainly. We purchased a modern A-grade asset, office asset, in Sydney Olympic Park for about, from memory, $52 million. It's a well-tenanted property opposite the train station there, and that was really a reinvestment from some older assets that we did sell in Sydney Olympic Park as well previously with Short Whale. So it was a really upgrade of a property there. So we spent $50 million there. And then we also took up our rights. We own a stake in ADI, ASX code ADI, which is now the Dexus Industria Fund. It used to be the APN Industria Fund. We took up our rights in a recent capital raising, equity raising, that was over $50 million, and we've maintained our pro rata investment. We see that because, as I was talking about before, the yields in the direct market for industrial property are so expensive, the relative arbitrage there we thought was quite good. We're getting a distribution yield on our outlay there of 5% without any stamp duty, and we realise since Dexus has taken over that management, they're going to seek to improve the quality of the portfolio and enlarge that, and there'll be more trading liquidity. So we thought the quality of the acquisitions, the larger portfolio, retaining our stake, and the attractive yield was compelling value for our security holders. So they're the two major investments we've made.
And with regards to just the balance sheet as a whole, in a very good position. Maybe just for some relative understanding, how does GOZ compare to other A-REITs with regards to balance sheet? Is everybody in a very similar position, and everybody's looking and chasing the same assets? Maybe just to provide a comparison on a balance sheet basis.
Yeah, a lot of our peers have gearing, probably plus or minus 2.5%, around 30. So some of them, for example, today, Centuria Industrial Fund bought some assets on debt, and the pro forma gearing is about 32. So I think, and then some of the larger funds probably have gearing down to 25. Typically, those larger funds have a big development book that they need to finance, so they do have naturally lower gearing, or their assets aren't income producing. So I'd say our gearing is relatively consistent with others, and it's slightly below our target range. The bottom of our target range is 35%, and our maximum is 45%. We'd certainly be comfortable with gearing going to the bottom of our target range, or maybe a little bit higher as well.
And just, I think you actually started off the office discussion highlighting that during your leasing activities that you're not seeing a significant shift in space requirements as well as lease terms, which is quite odd, given given the uncertainty.
Yeah.
So as far as you concerned from what you're seeing currently, you still happy that there aren't any significant shifts that are originating, as you come up and discuss renewals with office. They're not saying, okay, maybe we need to split our office, maybe we need more space, less space. It seems like the status quo has been maintained, which is quite an odd outcome, given the volatility from COVID.
It is strange. I mean, for example, we recently signed Samsung up for the Australian headquarters in about 14,000 odd square metres in Sydney Olympic Park. They were, during the pandemic, seeking to drop off some floors, and then they later came back and said they'd lease the whole building again for another 5 years. I think certainly the smaller to medium tenants, they're looking towards growth, and they act quickly because they don't have a big board, a big organisation overseas, management and board, so they make decisions very quickly. So we're seeing the smaller to medium-sized tenants act quickly. Generally speaking, they're in growth phase. I think where you see some hesitancy or some delay is probably the larger corporates, and particularly the larger domestic corporates. So it might be a bank, it might be a telecom or what have you. A lot of them haven't actually worked out their accommodation strategy. And what we've seen in the last 12 months, where there's uncertainty, they just stay where they are, and they kick the decision, the can down the road. So the easiest decision is just to renew their space and address it at some other time. Having said that, though, I think most companies see the strong economy coming, see the strong performance through COVID and the huge stimulus, and the very low unemployment, and they're seeking to expand. So I think there's a few themes to play out, but underlying demand will be strong. Sure, there'll be some retraction for some businesses with working from home, but not all businesses.
And just talking on leasing, you mentioned Samsung. Do you have an update on the other big lease for the year, the Woolworths lease? Expectations with regards to that? Are they going to take the option?
I think most definitely they will. Yes, it's a bit of a strange clause, but yeah, we believe they've issued a notice of intention to do that. Effectively, the lease says that where there's not agreement on the market rent for that facility, it goes to a determining independent valuer, and both ourselves and Woolworths have appointed valuers. They put a submission to an independent expert. The independent expert valuer determines the rent. So that process has just started, the appointment of that expert, and that lease finishes in February. But yeah, they will be staying. They use it. It's their largest distribution centre in Queensland, and one of the largest ones in Australia. And if anything, through this period, the supermarket chains have wanted more space than they actually have. So yeah, we believe they'll be staying, and the outcome of the rent review. Obviously, we've got something in our budget, but it's hard to say where that might come out against our forecast. Of course, the new lease starts in February 22, so it wouldn't materially affect this year's FFO and distribution forecasts regardless.
Just a reminder to all, if you have any questions, please pop them through to the chat box or raise your hands. Just give me a second here. Just as far as funds management, it's obviously something new, and there's various options available with regards to the entry into the funds management business. Maybe let's start with timelines, and is there any specific strategy that you're looking at with regards to a sector speciality or just what's your primary outcome here? Is to create this capital light business, or is that also aligned to a specific strategy within?
Part of it is in regard to capital light. I mean, typically, fund managers in Australia, if it's listed, they might have a 20% stake in the fund. If it's unlisted, wholesale, maybe a bit less, and then if it's unlisted, focused on retail investors, maybe 0 to 5%. So it can be a form of capital light investment. This period, current period we've been working on, and probably a short period ahead, or over the next 6 months or so, we have been reviewing opportunities in the market. Some of them have been evaluated and not proceeded with, and we'll continue to do that. There are opportunities out there that present themselves. They do take a while to work through and come to fruition. So we are working on that. We believe if there is a suitable acquisition for us in funds management, it's probably a better way to obtain scale rather than build it up over a number of years ourselves. Whilst the board and the management have considerable experience in funds management over many years, it does take a while to get economies of scale and synergies there. So our focus has been on identifying opportunities to purchase a platform.
And what kind of a PEs do these trade at?
That's a good question. The listed ones skyrocket. They're in the ether. Typically, there's a few that has been traded, and you can obviously look them up on the ASX. Where there's an explanatory memorandum about the transaction, the independent experts reports. Typically, and I'll quote those independent experts reports because people have different interpretations of measures, but typically they analyse the sales and apply the valuations at 10 to 15 times EBIT, maintainable EBIT. So 15 times might be for a well-established larger one, maybe in the listed market, whereas a lower 10 PE might be for a smaller business in the unlisted market, where you might have a lot of syndicates where they have a fixed term and they're not a perpetual. They're not a perpetual fund; they're closed-end fund. So between 10 and 15 times.
We've got a question from Ridwan. What is your view on consolidation in the sector, given distribution yields are more attractive than direct asset yields in some cases? Would GARS be an acquirer or a target?
That's a good question. I think the market as a whole will continue to look at listed property. I mean, we've seen the classic example of listed infrastructure with the Sydney Airport being purchased by, and that's just been approved by the Sydney Airport Board, but a consortium of superannuation investors. And we've seen things such as Charter Hall teaming up with Host Plus, which is another large superannuation fund, taking out ALE, which is a pub or licensed premises REIT. So we're seeing large super funds coming to the listed environment. We've also seen other M&A activity, and I think that's right. The probably the value relative to the direct market, and for buyers or acquirers to be able to get scale, I think that's an attractive thing, and I think there will probably be more M&A, over the next 12, 18 months. As for GOZ, we always look at M&As. We've done a couple of M&As of other listed funds over the period. They're not easy to do, and they take time to do, but certainly we review the market on a regular basis.
I've got one question on opportunities as well. So we've talked a lot about the Australian market, and your strong balance sheet and opportunities. Um, are you looking at all to go offshore, or is it primarily Australia only?
Um, Not at this point. We do from time to time look at assets in New Zealand, and Australians jokingly say that New Zealand's the sixth state of Australia, but our Kiwi friends wouldn't like that too much. But we're not constantly reviewing assets over there. There's sometimes we find attractive assets, modern assets, office buildings, well leased. But principally, we are concentrating on Australia, and principally along the eastern seaboard, where well over 80% of our assets are located.
And just maybe one final question from my side is, just you said the leasing incentives are reducing in certain areas. I think it was one of the slides with Parramatta as well as the Sydney market. Can you maybe just give us an update, on leasing incentives and the trend over the last, 4 to 5 years?
Yeah, certainly. I mean, over the pandemic, the leasing incentives have increased, which on a net effective basis has led to lower rents in the office market. So probably over the last, or from the start of the pandemic to now, incentives have probably gone up 10%. And they vary from state to state. They might have gone from 25 to 35%. They're lower in some markets and higher in others. What we have seen, though, is as the economy has opened up, that these incentives have stabilised, and we believe they'll plateau for another 12 months and start to lower over the next 12, 24 months. And I think that's the general consensus of the market, and certainly JLL have reported that in their research. So I think office rents effectively have bottomed, and we can see upside in growth, limited growth for a period, but then stronger growth a couple of years out. And as I said before, investors are looking through when they're coming to buy, undertake new acquisitions in Australia, particularly offshore investors. They're looking through that short-term pandemic environment. The other thing, of course, is the leasing market has been interrupted many times through COVID, and it's been very difficult for tenants to go and inspect, get their boards on board, get their staff on board, and move premises or change premises or lease. During the pandemic, when we've had lockdowns, stop-start lockdowns, so we've had 6 lockdowns in Melbourne. You open up for a short period, and you get the leasing inquiry, inspection inquiry coming back, and then there's another lockdown and it just disappears. So I think with the vaccinations well over 80%, and hopefully by Christmas up over 85%, and the economy opening up, now people are saying, well, let's go and look at new space, let's deal with our leases, let's put in place our strategy. And another particular thing too is to encourage people back to work. A lot of companies and businesses are saying, we need to be located in quality assets. So there has been what we have seen is a flight to quality. If you're in a B or C grade office asset and you're trying to attract people back to work, it's reasonably difficult. But if you've made a move to a brand new A grade property with all modern features, beautiful outlook, high green credentials, it's an easier way of getting staff back to the office as well. we have seen a flight to quality coming out of the COVID pandemic as the office market opens up.
We've got a question from Mauro. Good morning. Just referencing your comments earlier on cap rates, RBA is signaling has certainly become less dovish, with the possibility of interest rates now being guided for 2024. Surely this poses some risk to valuations over the next few years.
Yeah, the Reserve Bank, there's been a bit of a fight between the market and the Reserve Bank, and I think the Reserve Bank is a bit more bullish than they previously were. They're still saying that the cash rate at 0.1% will be raised late 23 or in 23, late 23 or 2024. And rates have moved back. But we see the long-term bond rate, and we see a medium-term cash rate as just normalising. So I think the weight of money and the weight of demand, and with the industrial market with rents growing strongly, and also the office market bottoming and obviously going to improve as the economy opens up, I think investors still think there's good value, and we still have a good spread to bonds as well. So because bond rates are falling, it's not a one-for-one, oh, that must mean property values are falling. I think the demand and the attractiveness of investment in Australia will still keep values healthy, and we're still seeing cap rate compression, even with the knowledge that bond rates will increase. So there will come a point, obviously, where bond rates rise, and that will affect valuations. I'm not saying it's not, and I'm not saying there's not a correlation, but I think in the short to medium term, the fundamentals of demand, supply, and tenant demand will dictate where the values go, rather than bond rates implicitly for a period of time.
Thanks, Tim. That's all the questions from my side, and it seems like I'll give the participants one more opportunity for questions. But other than that, do you have any final remarks or concluding remarks, and we can close the session off?
Yeah, just as we've discussed, the Australian economy is in a very good position, and that's reflected of demand coming through the market. And GOZ is in a very good position. We're in the best position we've been operationally and financially for some time. So, like many other REITs and businesses in the country, we're looking for growth opportunities that really drive earnings over the next few years. So, and just finally, thank you, Nazim, and thank you, Investec, putting on this seminar presentation this morning. I appreciate it.
No problem. Brilliant. Thank you, Tim, and thank you all for joining. See you soon in 45 minutes.
Okay.
Ciao.
Thank you.